My name is Josh Hewer. I am the Director of Business Development with My Wealth IRA, the Ultimate Retirement Machine, and we're here to talk to you today about prohibited transactions and what not to do in your self-directed retirement account. Let's start off by saying that My Wealth IRA does not promote, endorse, or offer any investments. We do not offer any investment, tax, financial, or legal advice to our clients. Any individuals who believe they need advice regarding their account or any of the information that we discuss today should consult with the appropriate professionals licensed in that area. A little bit of background about our company. We were founded by our CEO, John Gillane. John Gillane became a financial planner back in 1983. He went on to become the Vice President and Sales Manager of the Las Vegas complex for Morgan Stanley in 1996. And in 2005, he founded Mountain West IRA and received his Idaho real estate license. In 2011, My Wealth IRA was formed to nationalize and centralize our operations with Sterling Savings Bank as our sole custodian. My Wealth IRA is a premier provider of self-directed retirement plans, and all undirected funds in our accounts receive FDIC insurance through our custodial bank. A little bit more about our CEO. John Gillane is a member of the American Banking Association as a certified IRA services provider. He is the founder of the American Tax Savers Retirement Association, and himself is an advanced tax savers retirement investor. He spent 22 years as a financial advisor, retired as Vice President of Morgan Stanley, and has been the CEO of Mountain West IRA and My Wealth IRA for 7 years. So why self-direct? The benefits of self-direction is this type of account allows you to take control of your retirement funds. It allows you to invest in what you know and understand, and that understanding can lead you to drive higher returns by investing in a much larger range of retirement choices. Just the nuts and bolts of the mechanics of what we do in an IRA. On the left side is you as the investor. On the right side, you have your IRA, and in order to assure that your IRA conducts all of its transactions and does everything at arm's length from you as an individual, you're required to have a third-party administrator, and that's what My Wealth IRA does. We act as administrator on behalf of the custodian, which would be Sterling Savings Bank, on behalf of or for benefit of this little guy here on the top right of the chart, and we like to call him Uncle Ira. He is your IRA while he is invested. That maintains that he is a separate legal entity, and it is not actually you as the individual performing all of the investments. So it's very important to make that distinction between yourself and your IRA while the funds are still in that account and while those investments are being performed by the IRA. Self-directed retirement account basics. As I mentioned, we act as the administrator. The third-party administrator does the record keeping on behalf of the custodian, which is Sterling Savings Bank. All contributions into the IRA must be done in the form of cash, with the exception of transfers or rollovers from existing retirement accounts. The account must always be fully vested, meaning that any ownership that the IRA has in an asset is always an undivided interest, and the IRA funds cannot purchase life insurance policies, which is one of the things we'll talk about today. Snapshot of the type of plans that you can use for a self-directed account are traditional, Roth, SEP, or simple IRAs. As far as qualified plans go, you can have a defined benefit plan, like a PERS plan, defined contribution plan, such as a 401k, 403b, or 457. Getting into a little bit more of today's topic, tips to avoid scams. self-directed IRAs are most effective when you invest in what you know best and what you're comfortable with. Scammers are always very convincing at what they do, so always do your due diligence before investing. Scammers are almost always in a hurry. They will make you believe that if you don't make the investment now, you'll lose out on the opportunity of a lifetime. The more they want to hurry, the more you should always slow down and be cautious. The claims made by scammers are almost always unverifiable, and like John always says, if it sounds too good to be true, it probably is. We'll start off with a quote on prohibited transactions. A U.S. tax court quote said, "We conclude that the prohibited transaction rules contained in Section 4975 are just that. The fact the transaction would qualify as a prudent investment when judged under the highest fiduciary standards is of no consequence. Furthermore, the fact that the plan benefits from the transaction is irrelevant. Good intentions and a pure heart are no defense." So pretty much saying here that when it comes to your retirement account and prohibited transactions, there may be gray area in the interpretation of some of these rules, but when it comes down to the rulings, what your intentions are do not come into play whatsoever. It's either a violation of the rule or it is not. The types, we talk about all the freedom that self-directed retirement plans can give you, and they absolutely can, but there still are some restrictions that the IRS has put in place, regulations that limit what the IRA can do and who can be involved and what types of investments that it can pursue, and that's what we're here today to discuss. So the three types of restrictions that you have are on the types of investments, the people who can be involved, and then the transactions that ultimately involve those investments and those people. We'll get started with the investment restrictions. As I mentioned earlier, the first restriction that we would have would be life insurance contracts. Your IRA cannot invest in life insurance contracts or collectibles. The collectible would be defined as any work of art, any rug or antique, any metal or gem, any stamp or coin, or any alcoholic beverage. There are exceptions for the coins that can be involved. There are certain government minted gold, silver, platinum, and palladium coins that are allowable IRA investments. That would be any coins issued by the United States with that meet certain fineness requirements. They would have to be gold, silver, platinum, or palladium bullion. There are also other government minted coins that are allowable investments. So the people restrictions on IRAs. Who are disqualified persons? Well, disqualified persons are the persons who cannot benefit from or enter into transactions with your IRA or other retirement plan. So the number one disqualified person would be yourself. You cannot enter into or benefit from transactions with Uncle IRA or Uncle IRA. That doesn't mean that you cannot partner together with your IRA for certain investments, but you cannot directly benefit from a transaction involving the IRA. The next disqualified person would be any fiduciary of the account. Fiduciary would include any person who exercises any discretionary authority or discretionary control regarding the management of such plan or exercises any authority or control respecting management or disposition of that plan's assets. Would also include any person who renders investment advice for a fee or other compensation, whether it be direct or indirect, with respect to any monies or any other property of the plan, or has any responsibility to do so. Would also include any person who has discretionary authority or discretionary control or responsibility in the administration of that plan. So service providers could be considered fiduciaries and would be restricted or disqualified from being able to do business with the IRA. So My Wealth IRA would be a disqualified person from being able to enter into any transactions with any of the accounts it administers. An employer would be considered a disqualified person, as would any employee organization. As we mentioned, the fiduciary and the IRA would be disqualified from each other, as would other disqualified persons, such as certain family members. And the definition of family as it leads to or pertains to being disqualified, disqualified members of the family are defined as only a spouse, ancestor, lineal descendant, and any spouse of a lineal descendant. So the direct disqualified members of your family would be your parents, grandparents, children, grandchildren, or any spouses thereof. All of those individuals would be considered disqualified from being able to enter into a transaction or benefit from a transaction involving your IRA. And that would involve or include your own spouse as well. Little caution here at the bottom, although other members of the family are not automatically disqualified persons, meaning the non-lineal family members like brothers, sisters, aunts, uncles, and stepchildren, dealing with close family members or others may still be a prohibited transaction because of the indirect benefit rule. For example, in the IRS audit manual, it states, included within the concept of indirect benefit to a fiduciary is a benefit to someone in whom the fiduciary has an interest which would affect his or her fiduciary judgment. So the focus is not on the family member who may be a disqualified person, but rather the indirect benefit to the fiduciary who is a disqualified person. So if the involvement of a friend or non-lineal family member affects the fiduciary judgment, meaning you would be willing to enter into an investment for less than fair market value or provide benefit to another individual that may not be the most prudent for the investment, it ultimately leads to intrinsic value to the account holder themselves. So that's where the prohibited transaction takes place. As far as different entities, we talked about the persons who would be disqualified, but that doesn't end there. Would also be any entities that are controlled by or owned by any of those disqualified persons. So when we look at the IRA and its fiduciaries, which would include the IRA owner, it would be the disqualified people and entities would be the direct members of the fiduciary's family, corporation, if it is owned indirectly by 50% or more of any of those disqualified persons, a partnership, if it's owned directly or indirectly by 50% or more of a fiduciary or any other disqualified party, and same would pertain for a trust. If any of those entities are 10% or more partner of a joint venture of that company with the IRA, that joint venture or partnership would be disqualified as well. So what are the effects of a prohibited transaction? Prohibited transaction itself would involve the sale, exchange, or lease of property between the IRA and any disqualified person or entity. So the IRA would not be able to buy from, sell to, lease to, or exchange assets between itself and any other disqualified party. This would include the lending of money or extension of credit either to or from the IRA, and would also include the furnishing of goods, services, or facilities to the IRA or from a disqualified party to the IRA. Would also include the transfer to or use by or for the benefit of a disqualified person, meaning that if you own property in your IRA, that property must be for strictly investment purposes only and cannot be used by the IRA holder or personally or provide any personal benefit to any other disqualified party. Would also include any indirect or direct act by which a disqualified person who is a fiduciary deals with the income or assets of the plan in his own interest or for his own account. Meaning if you have a rental property, all of the interest or income generated from that investment must go directly back into the IRA and cannot be commingled with any of your own personal funds. Would also include the receipt of any consideration for his own personal account by which a disqualified person who is a fiduciary from any party dealing with the plan in connection with the transaction involving assets or income of the plan. So along that same line, just making sure that there is no commingling of funds or compensation provided to any disqualified person so that there's not a benefit received between any of those disqualified parties. So what are the consequences of a prohibited transaction? Is there an IRA jail? Well, if the IRS catches you, your IRA, there would be a penalty for the IRA holder is a disqualification of the IRA as of January 1st of the year of the prohibited transaction, plus taxes, interest, and penalties. So if the prohibited transaction took place over the last 4 or 5 years, January 1st of that year up to the present date that it was caught would all be subject to those penalties. That penalty for a disqualified person participating in a prohibited transaction, either approving or benefiting from a prohibited transaction, is 15% of the amount involved for each year, plus up to 100% of the value of the IRA if not corrected during the taxable period. So very, very severe consequences. You can lose your account. You can be taxed a minimum of 15% and a maximum of 15%. And that would be the penalty after your IRA would be distributed and become taxable. We're going to go over a few case studies here, just discussing prohibited transactions. The first one is Rollins versus the Commissioner. Joseph Rollins is a CPA, registered investment advisor, and benefits specialist trustee of his 401k plan. Rollins was considered a disqualified person as trustee of the 401k and 100% owner of his CPA firm. He loaned money to his own companies at an interest rate of 12%, which was then repaid back into his account. The companies in which Rollins was the largest shareholder and an officer, but still a minority shareholder. Rollins made the decision to lend as the trustee of the 401k and signed the notes for borrowers. Rollins did derive a benefit as a significant part owner of the borrowers from the borrowers securing financing without having to deal with any independent lenders. So he may not have derived a personal benefit, but the burden of proof was on Rollins to show that he did not receive a benefit, which he failed to do. He was the largest shareholder of the companies that were the borrowers and also the trustee of the plan that was the lender. The loans were a prohibited transaction, or they were multiple prohibited transactions under Section 4975, which would be a transfer to or use by or for the benefit of a disqualified person of the assets or income of the plan. The next case that we'll look at is the Leonard Adler Department of Labor Advisory Opinion, number 2000-10A. Leonard Adler and his family and other partnerships or other partners formed a partnership which included his IRA, and that LP invested money with Bernie Madoff Investment Securities. Obviously, we're familiar with that one. The holdings involved here is that you may be able to partner with your IRA in an investment made simultaneously in certain circumstances, and it would not violate Section 4975, meaning as long as you enter into the investment with your IRA at the same time, you can partner both personal and IRA funds together as long as the percentages of ownership remain consistent throughout the life of that investment. A prohibited transaction under 4975 will not occur merely because the fiduciary derives some incidental benefit from a transaction involving the IRA assets, meaning it is another partner in the transaction. However, a prohibited transaction would occur if the transaction was part of an agreement, arrangement, or understanding in which a fiduciary causes plan assets to be used in a manner designed to benefit that fiduciary directly. So that would ultimately affect the judgment of the fiduciary simply because of the IRA's involvement. If a fiduciary causes the IRA to enter into a transaction whereby the terms or nature of that transaction are a conflict of interest between the IRA and the fiduciary, that transaction would violate Section 4975. If you participate in an investment with your IRA, you must not rely upon and cannot be otherwise dependent on the participation of the IRA in order for you to undertake or continue your share of the investment. Even if at its inception a transaction did not involve a violation, if a divergence of interests develops between the IRA and the fiduciary must take steps to eliminate the conflict of interest in order to avoid engaging in a prohibited transaction. So like I mentioned, if there is a partnership situation between both IRA and personal funds, there must be a consistent percentage of ownership with all of those parties in order to avoid any of those prohibited transactions. So now that we have a better understanding of that, here's a quick overview on how to get started and open a self-directed retirement plan. Here's a list of the items needed to get started with opening and funding the account. You would need an application, a copy of our fee disclosure and prohibited transaction form. That form just shows that you understand the prohibited transactions that may be involved and disqualified parties involving the IRA. We would also need a transfer or rollover form to initiate the funding of the account, which would be accompanied by a statement from that current custodian, a copy of your license, and $50 to process the application. If you have any questions about anything that we've discussed today or any of the processes involved in establishing a self-directed IRA, you can contact me directly. Again, my name is Josh Schuer. I'm the Director of Business Development here at MWIRA. I can be reached at accounts@mwira.com. My direct phone line is 208-639-7771, and our main office can be reached toll-free number 866-377-3311. Again, this has been a presentation of the American Tax Savers Retirement Association, where we provide service through education. I appreciate you all taking the time to spend this time with us, and look forward to hearing from you in the future. Thank you.